Hello everyone. I would try to probably over the next few minutes try to give you a good snapshot of what happened in the bond markets, specifically as we have seen a change at the helm of the central banking in India. So for starters, we have Dr. Urjit Patel, who has taken over from Dr. Raghuram Rajan. The good news in this starter is, of course, that we have continuity. Probably because Dr. Patel has worked with Dr. Rajan on various monetary policy initiatives. So I think that's been a very good news from a market standpoint, both for domestic market investors as also foreign institutional investors. We have seen some reduction in the net negative flows into the bond markets. September has just begun, but the start has been fairly encouraging. We have seen net positive flows of FIIs in the bond markets. So when we say starters, we think about food. So what is the main course? So I think clearly the main course is the CPI or the inflation, which is obviously being targeted by the central banker. Right now, the headline number is a tad over 6%, but we clearly believe that this number should be heading lower in the coming months. And are we good to see a closer to a 5-ish kind of a number by end of this calendar year stroke financial year 2017? The answer is probably yes. So I think 5% kind of an inflation number, if that were to be the goal path, or that would be the way in which this number were to pan out. And of course, we have reasons to believe crude oil has been benign, which is a very critical import ingredient for us. Gold imports have been fairly muted for India as a country. So I think there is reasonable conviction that inflation trajectory could be headed on the lower path. Liquidity continues to be fairly comfortable in the system, which is why we've seen short run of the yield curve come down. So I think if all these ingredients were to be blended together, could there be formation of a dessert? And that dessert is probably the rate cut. Yes, we do continue to maintain incrementally 25 to 50 basis points rate cut on the repo seems to be a high probable event. We're agnostic of the timing, so I would not want to hazard a guess whether we see a rate cut in October or in December. But needless to say that even if the 25 to 50 basis point expectation is intact, which seems the case for now, there is the case to be invested in duration strategies. So what should be the strategies one should focus on in this market? While duration, which is the gilt and the bond strategies, have seen a reasonably good dream run, incrementally the yields have come down. The 10-year benchmark today as we speak is under 7%, and we continue to believe that this could head towards the 6.5% region over the next 6 to 12 months. However, since bulk of the gains have got upfronted, incrementally it could be very difficult to do a repeat of what we've seen in the past couple of years. We therefore, while not retaining a negative bias, would suggest that incremental fixed income allocations could be probably overweighted in short duration stroke accrual strategies, with probably an icing or a cherry in the form of duration to the tune of maybe 10 to 15% of the AUM. This, we believe, could probably offer a stable bias on your fixed income portfolio. On a concluding note, the rally has been fantastic, but is this a dream run or a make-believe rally? We clearly believe it's the latter. So stay put, stay invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.